If you're carrying, the weight of student loan debt, especially with all this talk about collections lately, you are absolutely not alone. Welcome to another deep dive from Empowering Your Finance. Today, we're really digging into something critical. Student loan wage garnishment update, prepare and protect your pay. And the urgency, while it feels pretty real, TransUnion estimates suggest roughly 3 million borrowers could be facing wage garnishment pretty soon, like this summer, specifically by August 2025. And then maybe another 2 million on track to default by September 2025. So our mission today is to unpack what wage garnishment actually means for federal student loans, what protections are really there, and crucially, what steps you can take right now. Okay, let's unpack this. What happens when federal student loans go into default? And maybe more importantly, what can you actually do about it?
Yeah, and to really get a handle on this, you have to see how fast things are changing, especially since that pandemic payment pause ended back in May. We're already seeing, big hits to credit scores, warnings coming straight from the Department of Education, and just, a lot of uncertainty for millions. Now, default, when we talk about federal loans, it usually means you're about 270 days past due, or maybe over a year with no payment. And for a lot of people, because of the pause, they haven't been in this situation for maybe 5 years, which explains some of the confusion and, frankly, the anxiety out there.
That's a really important point. So what is the key difference between just, say, missing a payment and actually being in default, and what happens immediately?
All right, that's vital. Delinquency starts basically the day after you miss a payment. Simple. But default for federal loans, that takes time. It properly kicks in after those 270 days. And the immediate consequence, which honestly shocks a lot of people, is that your entire loan balance suddenly becomes due, not just the payments you missed. And something interesting from our sources, it's actually not that uncommon for borrowers to have no idea their loans are in default.
Yeah.
Especially if maybe you went to college at different times or you have loans with different servicers. It's easy to lose track with multiple accounts.
Oh, that sounds incredibly stressful. The whole balance due and not even knowing. For someone facing that with maybe credit scores dropping and the debt growing, what's the biggest barrier to just starting to deal with it? Is it finding the info or just the sheer stress?
I think it's often both. And the personal cost, it's really deep. Our research showed these pervasive long-term ripple effects. We saw examples like credit scores just plummeting. Someone went from the high 600s down to the mid 500s. Another person dropped from 700 clear down to 540 after defaulting. And that's not just a number, right? A damaged credit score affects pretty much everything financially. Getting new loans, credit cards, even renting an apartment becomes incredibly hard. We even saw mentions of problems getting mortgages because, lenders just weren't familiar with these situations. And then there's the interest. In default, it piles up aggressively. It accrues daily, not monthly. One person shared how their loans jumped from, I think it was $54,000 up to $77,000 because of that. And beyond just the money, the sources really highlighted how default haunted for years, made clearances difficult. It causes huge stress. It even affected people's ability to co-sign loans for their kids, pushing them into higher interest private loans. It's like this financial quicksand.
Okay, given those really severe consequences, let's pivot to what this means for your actual paycheck. When it comes to federal student loans, you mentioned the government has different tools, stronger tools. What should people absolutely know about wage garnishment specifically for federal loans?
Yes, the crucial difference, the one thing to really remember, is that the government doesn't need a court order for wage garnishment on federal loans.
Right.
They can just do it administratively. They can withhold up to 15% of your disposable income.
Disposable income, that's after taxes, right? Your net pay.
Exactly, your take-home pay after mandatory deductions like taxes.
Mm-hmm.
But there is a protection there. You have to be left with at least $217.50 per week. That number comes from 30 times the federal minimum wage, which is still $7.25. And it's not just wages. The Department of Education can also intercept your federal tax refunds.
Even if you try to avoid getting a refund, like underpaying estimates.
Yep, even then. They can also garnish Social Security, retirement, and disability benefits, again, up to 15%. Though for Social Security, you must be left with at least $750 a month.
That's quite a reach. What about people who are self-employed or run a small business? Is there a common misunderstanding there?
That's a really interesting point that came up. There's this belief sometimes that being self-employed, maybe getting 1099 income as a contractor, makes you immune. But our sources are clear. Being your own employer does not protect you from federal garnishment.
Okay.
And if you haven't kept your personal and business finances strictly separate, the government might even be able to seize company assets.
Wow. Okay, so how does that compare to, say, private student loan?
Big difference. For private loans, The lender must sue you and get a court judgment first. They can garnish potentially more, up to 25% of disposable income in some cases, but certain income types are usually protected from private collectors, things like Social Security, child support, alimony, pensions, IRAs, 401ks. So stepping back, you really see the federal government's unique power here for collecting these specific debts. Understanding that administrative power is key. Oh, and also important, you do get a warning. The Department of Education has to give you 30 days notice before they actually send that garnishment order to your employer.
Before we dive deeper into solutions and some of the newer repayment plans, just a quick moment here. If you're finding this deep dive valuable, and we really hope you are, please take a second to follow, subscribe, like, and comment. Your engagement genuinely helps us bring these crucial insights to more learners like you. Okay, back to it. So, the good news, you said, is that you're not helpless. There are things you can do. Steps to take to prevent default, get out of it, and protect your wages. What's the absolute first most important thing someone should do if they're worried?
The single most important step right now: log into studentaid.gov. Check your status. Are your federal loans actually in default? And if they are, start taking steps now to get them out. Also, call your loan servicer immediately if you know you're delinquent or already in default. Don't wait for that garnishment letter. Be proactive.
Okay, proactive. What are the main ways to actually get out of default once you're in it?
Absolutely. There are a few main paths. A key one is called loan rehabilitation. Think of this as mostly a one-shot deal per loan. You usually only get one chance at it. It involves making 9 consecutive on-time payments, and these payments are based on your income. We saw some people in our sources reporting payments as low as $5 a month for this.
$5? Seriously, that really shows how specific these programs can be. You need the details.
It really does. And the huge benefit of rehabilitation, the main reason it's often recommended first, is that it removes the actual default notation from your credit report. That's massive for rebuilding your score.
Okay, removes the default. That sounds like a big win. What's the alternative?
The main alternative is loan consolidation. This also gets the loan out of default status quickly. But, and this is the key difference, consolidation does not remove the record of the default from your credit history. It'll stay there for about 7 years. On the plus side, it can simplify things by rolling multiple federal loans into one single direct consolidation loan. Sometimes you might even get a slightly different interest rate, though that's not guaranteed.
And you mentioned past programs like that Fresh Start.
Right. It's useful context.
Yeah.
The Fresh Start program ran from late 2022 to late 2023. It's basically like a free, automatic rehabilitation. It just instantly took eligible loans out of default and wiped the default off the credit history. No 9 payments needed. Importantly, if someone used Fresh Start, they could still use the standard rehabilitation process later if, heaven forbid, they defaulted again. It just shows how options can change and why staying informed is so important.
Okay, so rehabilitation, consolidation. What if you actually get that garnishment notice? You mentioned rights.
Yes, absolutely. When you get that 30-day warning notice, you have the right to request a hearing in writing to object to the garnishment. You need a valid reason. Things like proving extreme financial hardship, or maybe proving you haven't been at your current job for 12 months straight if you were laid off from your last one. Or maybe you already have applications pending for other ways to discharge the loan. If you request that hearing within the 30-day window, the garnishment cannot start until they make a decision. That's crucial. But if you wait and request it after the 30 days, the garnishment usually won't stop while they review your request. And one more really important thing. Your employer cannot legally fire you just because your wages are being garnished for student loans.
That's good to know. Are there other ways loans might just be forgiven or discharged entirely?
Yes, there are statutory discharge options in specific situations. It's not common, but possible. For example, if the school you attended closed down before you could finish your program, or maybe if your school owed you a refund and never paid it. Total and permanent disability is another major one. There's a whole process for disability discharge, and you can even apply with just a doctor's letter sometimes. You don't always need a formal federal disability determination first. And bankruptcy is becoming, well, slightly more possible. The Department of Justice has a newer process to look at undue hardship a bit more leniently now. They might even consider discharging part of the loan. And a practical tip, if you hit roadblocks dealing with your servicer or the Department of Ed, sometimes contacting your congressperson's office can help. They have staff who assist constituents with federal agency issues.
Okay, so those are the existing routes. But you mentioned things are changing. There's this new plan, RAP.
Yes, the landscape is definitely shifting. A huge change is the new Repayment Assistance Plan, or RAP. It was signed into law July 4th, 2025.
And this changes things significantly.
Fundamentally, RAP basically overhauls the whole federal repayment system. For anyone taking out new loans, it eliminates access to all the old income-driven plans we know, like SAVE, PayWayE, ICR. Those are gone for new borrowers. And if you're currently on SAVE, PayWayE, or ICR, you'll be automatically moved over to a version of IBR that's the older income-based repayment plan sometime between 2026 and 2028.
It's a really big restructuring.
Wow, okay, so how does RAP actually work? How does it calculate payments differently?
It's a radical departure, really, unlike all the previous income-driven plans that looked at your discretionary income.
Which was like income above a certain poverty level threshold.
Exactly. RAP calculates your payment based on your gross income. Well, technically, your adjusted gross income, or AGI, from your tax return. This means it basically scraps that income protection feature of the older plans, and this is critical. It will require payments even from people earning way below the federal poverty level, which is currently around $15,650 for one person.
So even very low earners will have a required payment.
Yes, it's a tiered system. If your AGI is up to $10,000, the payment is $10 a month. Then from $10,001 ROS up to $20,000 AGI, it's 1% of your AGI, and it scales up from there, all the way to 10% of AGI if you earn over $100,000. There is a $50 per month reduction for each dependent child you have, but there's always a minimum payment of $10 a month, no matter what.
Are there any, potential downsides or quirks to this structure?
Well, one potential unintended consequence that our sources flagged is something called the cliff effect, because the percentages change at specific income thresholds. A tiny increase in your income, like just $1, could push you into a higher bracket and cause a disproportionately large jump in your monthly payment.
Can you give an example?
Sure. Someone earning, say, $30,000 might be in a tier paying $50 a month. But if they earn $30,001, they might cross into the next tier and suddenly owe $75 a month. That small income change leads to a big payment jump. Another major change is that RAP extends the maximum repayment time frame out to 30 years.
Longer than the old plans.
Yes, much longer for many borrowers compared to the 10, 20, or 25 years in other plans. This could make it harder, especially for lower income borrowers, to ever fully pay off the debt. So connecting the dots. Proponents argue RAP helps people repay faster, but that really just means it forces higher payments. The big concern highlighted in the sources is that if these payments are truly unaffordable for low-income folks, it could be a recipe for default disaster, pushing even more people into that tough collection system we've been talking about.
That's a serious concern.
One last note on RAP. Parent PLUS borrowers are completely excluded from it.
Okay, so wrapping this up, what's the main takeaway for listeners dealing with federal student loans right now? Ultimately, for your own financial well-being, being proactive is absolutely your best defense. We really can't stress that enough. Check your loan status on studentaid.gov. Understand exactly what type of federal loans you have. Explore the options we discussed, rehabilitation, maybe consolidation immediately. Federal student loans, they don't just disappear. There's effectively no statute of limitations on collecting this federal debt. So whether it means picking up the phone and calling your servicer, looking into rehabilitation, or just understanding how a new plan like RAP might impact you down the line, acting now is key. It can help you prepare and protect your pay from some really serious consequences.
And maybe a final thought to leave people with. As we see these huge shifts, like RAP completely changing the rules, it raises a really important question, doesn't it? In a world where financial systems are always evolving, and there's tons of information out there, but it's often so complex, how do we make sure that knowing about our financial obligations actually empowers us to act effectively? Instead of just reacting when trouble hits. Remember, just knowing this stuff isn't enough. Knowledge is most valuable when you understand it and then actually use it. Don't let fear paralyze you. Use these insights to really engage with your debt and start shaping your own financial future.
Great point. For more insights on managing your finances and just generally staying informed, definitely check out Empowering Your Finance. And for more deep dives like this one, wherever you get your audio, please remember to follow and subscribe. And if you found today's deep dive valuable, please do take a moment to like and comment. That engagement really helps us get these insights out to more people who need them. We'll be back soon with another deep dive.